Hello, everyone, and welcome to this week, December 8th edition of the GoNoGo show. It's just me today. I'll be running it solo. Tyler's traveling again. Next week, hopefully before the holidays, we'll be both back to run through the markets. But don't forget, if you enjoy this show, like and subscribe to the StockCharts channel so you don't miss anything. You can also check out our YouTube channel as well, where we have a lot of educational content in addition to these shows. And also, don't forget to check out the on-demand StockCharts app so that you can take this stuff with you. StockCharts TV, give that a look as well. So let's get started. We'll jump right in as we usually do. Let's take a look at the asset map. Now, remember, if you're familiar with GoNoGo charts, fantastic. Great to have you back. If you're not, what we do at GoNoGo charts is blend the foundational concepts, principles, indicators, of technical analysis into something that color codes price so that you get all of the technical analysis you need without overwhelming and complicating your chart. Now, when we apply that to the maps, as you can see here, we do it in a way that just paints the panel and gives you just a reflection of trend strength as the colors come in and out for each security in the panel. So we're not even looking at price movements here. We're just looking at strength of trend. And as we always have, we have the S&P as a representation of U.S. equity index. In the top panel, we have Treasury bond prices represented by TLT. In the second, we have the U.S. commodities index in the third, and then the dollar index in the bottom. And you can see that we are still relatively risk on. We can see equities have remained in their go trend. Let me just put the SPY in the top panel. I would like to have that as the price panel. You can see that they've remained in their go trend, but have weakened a little bit this week. Tuesday, Wednesday, Thursday, we've seen some corrections against the strength of the go trend that we saw last week and into the beginning of this week. Especially Tuesday was a strong down day, but seemed to hit support, which is a good sign. And we've remained in go colors, albeit weaker aqua ones. Now, Treasury bond prices, the TLT fund has strengthened its go trend. We see strong blue go bars here. And the commodity index has really struggled to make up its mind. It's been very choppy. We've seen some attempts to return to a go trend. We've seen that threatened, and then we've seen the odd no-go color. And again, at the moment, we're seeing pink no-go colors on the commodity index. So a weak form of the no-go trend based on, again, that blending of foundational technical concepts into coloring these bars. And the dollar, of course, which might be helping provide some tailwind for equities and other risk assets, still in a strong no-go trend. And we'll get into all of these charts as we move through the show. So first, let's take a look at the SPY, right? The US domestic markets. And this is what we're looking at. We are in a go trend. We are trying to set higher highs, higher lows. We've obviously got the high from the summer to contend with. We'd love to get above that to really believe that this go trend is going to be fairly long-term and going to be able to propel us higher. But we are still in a go trend. And here's where I was talking about finding that support. Looks like Tuesday's bar dropped us right down to support we've already had in this go trend, as well as resistance that we had in this previous no-go move. So we seem to find a little support this week. Today's been a nice bounce back in terms of rallying from those levels. We're up about 0.7% today as we speak, and we're about lunchtime on Thursday. I know the show won't go out just yet, but we seem to be having a nice day today, bouncing higher. Now, what we always want to look at in conjunction with the trend indicator is, of course, what's happening with GoNoGo oscillator. So GoNoGo charts in its concept is trying to simplify all of the technical analysis, that checklist of sensible principles, into something that is simple to read. So we want one price chart with nothing on it, just coloring those price bars based on strength of trend. And then we have an oscillator panel that gives us all of the information we need in terms of momentum, volume, and volatility. So we only need that one sister panel, and that's what we're seeing at the bottom. And what we're seeing is we are testing the zero line from above. In GoNoGo charts, this zero line is an objective level that can be used as support and resistance. You can use it as resistance in a downward move. You can see no-go trend in place, resistance at zero. When that fails to hold as resistance, that's a threat to the no-go. We see the go then take hold, and now we've been finding support at that level. So a very important inflection point as we find horizontal levels of support here in price rallies. We're also testing the zero line on the oscillator. So we'll want to see this hold as support if we think that this trend is going to continue, and we'll look for then over the next week or so, perhaps potentially an attempt to hit a new high on price. But what are the macro factors that really affect these risk assets? Well, let's go to the Treasury rates first. Here's your TNX Treasury rates, and you can see that this most of the year has been providing real headwinds because of that rising rate environment. And now we see how it's rolled over into a no-go, and we can see that we are moving lower again. Strong no-go purple bars continue this week. The oscillator is in negative territory, telling us that momentum is on the side of the no-go trend. And about a week ago, you can see how we broke below this support level and actually gapped slightly lower, and we've been below that ever since. So moving lower on the no-go, on strong purple no-go bars. So a real no-go trend in Treasury rates. But what about if we move this out of time frame and we look at it on a weekly basis? Now, we always like to encourage multi-time frame analysis for our clients. And so we would certainly want to keep the context of the larger time frame in mind when we are talking or thinking about the markets. And of course, we know that on a longer time frame, generally speaking, we are in a rising rate environment. We are having Treasury rates move higher. We've been in this 4-decade-long downward sloping trend of rates, and we are seeing that move higher this year. You might have seen a really long-term chart that we sometimes look at, but this one is just a weekly chart, and you can see that we are still in a go trend, albeit painting weaker aqua bars here. And that's pushed the oscillator back to test the zero line. So on the daily chart, we are seeing relief from rates moving down in a no-go, strong purple bars. On the weekly chart, we are correcting from these highs. This is our counter trend correction arrow. Go counter trend correction arrow here, this red one. We can see that we are moving away counter to the trend, but we have now hit the zero line. So we will look to see if this zero line provides support. And if it does, we may see this longer term trend continue, which would mean what it would mean for equities. We'll have to take that into consideration if and when that happens. Okay, so let's move on from Treasury rates and let's take a look at the dollar, which is, of course, something else that really has an impact on our equities and risk assets. So let's go to the dollar daily first. This was the trend that confounded everybody the whole year. Lots of analysts calling for a rollover, and the dollar didn't happen. Well, it certainly did towards the end of October and into November. We saw this movement sideways, correcting against the high here, this counter trend correction arrow, telling us that it was going to be difficult for price to move higher in the short term. And of course, that caused the oscillator to fall to the zero line, where we see the GoNoGo squeeze build to its max. This orange grid is the GoNoGo squeeze indicator, telling us we're seeing reduced volatility. And often on a break of that reduced volatility, we know that that can be followed by increased volatility and a significant move. So when we saw that break out of a max squeeze into negative territory, we really thought that this go trend was threatened. And then, of course, we roll into no-goes. Oscillator finds resistance at the zero line, and we've been in a no-go ever since. And we've set several lower lows and lower highs. And so we are still in a strong no-go on the dollar on a daily basis. So again, on the daily basis, Treasury rates and the dollar, their trends will be looking to provide some tailwind for equities. And let's take it out to a weekly chart. And what do we see? Well, this is interesting. we are now seeing some reason to doubt the strength of the Go trend in the dollar on a weekly basis. You can see that we've been in this incredibly strong Go trend for a year and a half, and then we've corrected against the high like we did on the daily, but in much more meaningful way on the weekly. String of aqua bars. But what do we see down here in the sister panel? We see the oscillator breaking below zero, not finding support at that level, which is what we would expect if the trend is to be healthy and persist. So right now we're seeing some negative momentum, some overselling, which is of course a concern for a Go trend. So you can also imagine the trend line on here that's been broken. We could probably be trading below that with momentum in negative territory. So we are less convinced in the health of the Go trend on the weekly chart of the dollar. Let's move on to the oil chart. And we've been looking at this weekly chart for quite a while. You can see how we fell out of this Go trend, again, with the leading indicator coming from the oscillator panel as we failed to find support at zero. We broke below, we found resistance. We then rallied to test that level, found resistance again. And what you can see this week is that we have been rejected by the zero line again on heavy volume. So one other thing to point out, if you're new to GoNoGo charts, is that the oscillator goes to a darker blue when volume has been heavier than its average. So we know right now that volume is heavy on this rejection of the zero line. And that, of course, gives us a no-go trend continuation icon, the red circle, telling us that the no-go trend is in place and momentum is now surging once again in the direction of that trend. So not a good picture if you're a oil bull on the long-term chart of oil. We're no-go colors. The oscillator's been rejected by the zero line again. We're moving below the support here, this horizontal support. So not a good sign for oil. Okay, so let's take a look now. Let's go into a bit more detail with the equity markets. We'll go to the sector RelMap. We've had a look at the macro factors that we like to track that will be having an impact on the equity markets. So let's now break the equity space down by sector and take a look at what's leading and lagging, what's underperforming, what's outperforming. So there's been some change. We've been seeing some change on this map for quite some time. Remember, for several weeks, it was the middle of the map that was really giving us the outperformance. And that it still remains true in most cases, but we can see that energy, this panel, the fourth panel here, has rolled into a no-go and is painting strong no-go bars. We saw that on happening on that last chart of USO. And you can see that here in the energy sector as well on a daily sector map that we've rolled into a no-go. So the energy sector no longer leading. And also, interestingly, a first no-go bar for the financials sector. So you can see more no-goes creeping in, but still a lot of goes, right? So we're still looking at 6 or 7 go trends. So on the balance, we're looking at a majority of go trends on a relative basis to the S&P. We're seeing utilities come into a strong go trend on a relative basis, along with staples, healthcare, materials, and industrials. Now, those are usually you'd think of as more defensive sectors. So yes, we've got some outperformance in equities, which is a good thing, but they are coming from what tend to be the more defensive sectors. Having said that, if we look at the top panel here, this is technology. So technology on a relative basis is outperforming and in a strong go trend relative to the base index. So very interesting there. And we're going to take a look at the technology chart coming up here in a minute. But interesting to see how that's changing, and interesting to see how we're getting this rogue outperformance from the technology sector. We haven't seen it yet for discretionary or for communications, but we are seeing it in technology. So if you have our research, you'll have seen some ideas coming out in the technology space. over the last couple of weeks. But let's have a look at that technology chart. Here's the XLK now. And you can see we've got some resistance, some horizontal level that's been resistance and support on the chart already. And what I like to show here is just how the go-no-go components work together. We had that no-go trend in place, as we did on the S&P itself, but you can see how we are higher than this level of support on the right side of the chart. You can see we went into a go trend. You can see how we found support at these levels. And interestingly for me, this is what I was looking for this week. We seem to have found support at that level again, right? We had that strong down day Tuesday, but bounced right back up off the support level. Now, when we turn our eye to the oscillator panel, this is where we can use our go-no-go oscillator to give us that leading indication of what's happening. You can see as this no-go correction bottomed out, the oscillator was unable to find resistance at the zero line. It did get rejected again. It got rejected here, it got rejected here, but this time we broke into positive territory. And that gives us a leading indication that this no-go trend is no longer healthy. We saw some amber bars. We saw it try to go back to a no-go. We saw another amber bar, and then again, the oscillator finds support and stays in positive territory when the go trend took hold. And then since then, we've been moving mostly sideways, but with the oscillator finding support at zero, which is a good sign. Now, right now, we're back at the zero level, and we are looking to see whether or not we'll find support there one more time. And if we do, then perhaps we can have enough of a push to get above prior highs and set a new high, which would be a good sign of the robustness of the go trend and the hope that it might persist. We need to find support here on the oscillator, so we're going to be watching this quite carefully. Now, one of the securities that I put out in our Monday morning pre-market research this week was Amazon. So this is an interesting case of when you're, what to do or what happens when a thesis is wrong, right, or proved wrong by the markets themselves. So I remember looking at this chart, and let me just throw a couple of lines on here so you can see what I was looking at. And Monday, I was seeing what I thought looked like some bullish, not divergence, but some bullish activity where you can see that we were making a higher low in price, and that being confirmed by the oscillator testing the zero line. And so this to me looked like a bit of a basing pattern, and I was noting how we were in a max go no go squeeze. And if your thesis was that technology is outperforming, growth sectors might follow, of course, Amazon is in discretionary. And if your thesis is that we're getting a bit more health out of the growth sectors, then perhaps Amazon would be one to watch for a go signal. But of course, we were in a max squeeze with the oscillator at zero and in a no-go trend. So of course, the weight of the evidence is still bearish at this point. We're in a no-go, oscillators testing the zero line from below in a max go no-go squeeze. And then of course, we saw Tuesday, the squeeze broken to the downside and a no-go trend continuation icon, this red circle saying that no-go trend in place, momentum once again resurging in the direction of that trend. So we've got bearish momentum, we've got some overselling, we've got a no-go trend in place. So the idea that Amazon might rally was one that was just an idea. We were always talking about not predicting, just reacting. So the go-no-go squeeze told us that as long as this squeeze was in place, we weren't going to do much until it was broken. And then of course, it was broken to the downside. And so no-go trend still in place on Amazon. And then here's just another chart just to throw out there because it's something that came across my screen this morning with a go trend continuation. So this is something that is now looking at strength in the face of some adversity. This is in the discretionary index as well, but it's home construction. And so we are seeing a go trend in place, support at the zero line, and that gives us that go trend continuation green circle. So the oscillator finding support, rallying off the zero line, immediately bouncing back into positive territory. That's an opportunity to to make the case that we are in a go trend and we are seeing momentum on the side of that trend. So DHI looks strong currently, making a series of higher highs and higher lows with that support this week. So that's it from me. Remember to check out the YouTube channels, and of course, look for both of us to be here next week. And as we approach the holiday season, I hope everybody is safe and well, and look forward to breaking down the markets again next week. Take care, everybody.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.